Good morning and happy Tuesday. It's July 11th. Another day, another episode of Markets Daily. Thank you for tuning in as always. We have lots to cover with our guests today, but first, let's get a quick update on prices and what's happened so far this morning because we did get a fresh CPI reading just now at 8:30 a.m. Eastern Time, which showed that inflation has fallen to 3%, which is lower than expected. So very good news for the market, and Bitcoin jumped about a 0.5% on the news and is up 2.22% over the past 24 hours, trading at $59,000. Fed Chair Powell also continued his week of appearances on Capitol Hill yesterday and said, among other things, that the Fed will not wait until inflation is back down to 2% to start cutting rates. He also said that the interest rates will not be going back down to near zero territory, which they were at before the pandemic. So it sounds like we could maybe see a rate cut or two this year after all. But let's get a reaction and more to all of this with our guest today, which is Ben Emons, founder and CIO of FedWatch Advisors. Good morning, Ben.
Good morning. Thank you for having us.
Of course, Ben, what do you make of today's fresh reading of the CPI report?
Yeah, as you mentioned, it's a good report. It does show that the disinflation, as we talk about, right, that's the decline of inflation month by month, that is really on track now. It's not accelerating, but it's in a good pace, and I think this is satisfactory to the Federal Reserve. As you also said, like the Fed won't wait until this number actually hits 2%, and we're getting closer to it. So it means that also for the Fed, this decision of cutting rates gets closer. Whether it will be September is still a little bit up in the air. I think that I didn't see the chance for September changing too much yet, but yields are definitely declining in reaction to this number. What's important here too is that not only that the headline was down, there's a lot of energy effect there, but it's really the core number that dipped a little bit lower, and that's because the rental component that finally shows further deceleration. That's really good news because that's been where the issues have centered around inflation, sticky rents, and then some of the services aspects of your CPI too. So we take it all together. I say it's fortunately a good number again. It's the third good number after three first bad numbers we had at the start of the year. So we're getting, at least neutralizing the trend from the start of the year. So hopefully the next few numbers are good too. Either way, I think it's a good day for the markets.
Now, I just previously mentioned that Fed Chair Powell said the Fed is not going to wait until inflation is back down to 2% to start cutting rates. 3% seems pretty close considering where we're coming from. So, is this a good enough place to start cutting rates? Maybe not in September, but maybe, towards the end of the year.
Yeah, I think that's what the market is on to. Like this September cut happens because of party. I think the technicalities that it plays out in futures markets, but you really look at the cumulative number of cuts that are really priced in. It starts actually as of December. And so I think this is the path. Like the Fed has a little bit of time here to say, hey, we're getting really inflation to the direction that we wanted it, and it really plays into their hands, so to speak. So, you're getting a bit of a repeat of what I wrote in my note this morning. What reminds me this is 2015. That was, by the way, a bad year for markets. But what it was really about was this heightened speculation around the Fed when it would hike rates at that time. And back then too, everybody was focused on September and said, well, they were going to do that, and they ultimately didn't do it because out of caution, and they decided to do this in December. That seems a bit similar to today. What was interesting at that time was that October was a huge risk-on rally in markets when the Fed finally gave forward guidance to the market saying, we're now ready to cut rates. And that's, I think, still missing here for the markets today. This number won't give Powell immediately the reason to give us forward guidance, meaning, okay, it's a good number. We're going to cut rates in September. He held off on that yesterday, and I don't think that would change his mind today either on these numbers because it just shows it's on track, but it's not yet there, right? So as you mentioned, we're at 3%, not 2%.
Right. It's interesting that you bring that up because now CPI and the unemployment report are, of course, the two most relevant economic reports that the Fed looks at, but there are many more indicators for the state of the economy, and some have been, rather weak over the past few weeks. So, how much can we really, listen to what Powell is saying as opposed to look at the actual data?
Yeah, and that's where the economy is because it's been now for some time that forward-looking indicators, leading indicators, all point to this weakness. and has made commentators wary, if not very like scared about, oh, we already are in a recession, and we're not careful enough, the Fed's over tightened, therefore we're going to end up in a really bad recession. And that's not really played out, partly because I think, again, the idea of forward looking is just based on surveys and based on certain indicators that by definition are more forward looking. They're not necessarily always right, right? Because just like interest rate expectations have been over many years wrong, what the Fed ultimately delivered in terms of rate hikes or cuts. So I think it's really the harder data, like a CPI, like a payrolls report, like the jobless claims this morning. Notable, jobless claims dropped back down to 222,000, the lowest in I think the last 4 or 5 weeks. It still underscores like, is the labor market cooling but not really deteriorating? That's the hard data. That's, I think, what matters a bit more than these forward-looking indicators. Although they're not wrong, but they tend to overextend, and therefore, I think as an investor, I say, like, I just take this hard data and I look at the trend in the hard data. And what it tells me from CPI today is that we had two bad prints in the start of the year. We're getting two good prints, three good prints now back. So my trend is flat. So I could say, okay, if the next number comes out better than expected, like weaker, so to speak, then we really could say like this rate cut is close.
Right. Now, going back for a second to, Powell's words, the market, including crypto, has been reacting positively to Powell's remarks this week. Is the market right here in taking his words as a bullish indicator?
To an extent, because he was cautious and he didn't want to give obviously any guidance, as I mentioned, but I think what they're parsing from it is that he's these words about modest further progress on inflation and significant cooling in the labor market. Those sort of modest and significant words are for markets to say, "Wow, you won't say words like that if you weren't closer to your in your mind to a decision, right? Of when you're going to cut rates." I think that's all this sort of fat parlor game, as we call it. Uh, you
Hmm.
know, and I think this is why markets are hanging on to those words might just start rallying again. As you mentioned, like, risk on markets like Bitcoin or the S&P 500, gets a lift from that because what those markets really are doing is just discounting forward when the Fed will actually cut rates, and that just lifts those prices. I would say, on the other hand, that interest rates, as in Treasury yields, have been rather range bound. We're now more like the lower end of the range. We still haven't seen significant move down there in yields yet, and that's because, including today's number, it's disinflating, but it's not like say we're going to go to a deflation environment, a really low inflation environment. That's not what the data is saying. So I think markets are taking Powell at his word. They want to still see several months of data before they actually make that decision. Is the takeaway?
Now, the Fed has two mandates, as you know better than me. It's keeping inflation low and the labor market strong. Between those two at the moment, what would you say is the Fed mostly focused on, or what's their priority right now?
I think there's still inflation that's the highest priority because the labor market is coming into balance, and that's the wording they've been using the last 6 months or so. And that's just nothing else than just seeing the payroll growth moderating further and seeing these jobless claims go a little higher and the unemployment rate ticking up a little bit. And it's really driven by supply of labor because of all the immigration inflow into the labor market. That's actually added net supply of workers. And that has led to this cooling trend. So they're looking at that saying like that's normal healthy pattern in the labor market that was before really sizzling and hot. And as a result, wage gains are somewhat moderating. But the inflation numbers, they've and that's what these reports in the minutes been also highlighting. Like it's slow progress, right? They had a good progress last year, and then it stalled and it slowed and became a little bit worrying. And we're maybe now back on track, but we're still slowly progressing, and I think that's why that makes them cautious. Of like, if it's that slow, we can make quick moves here with rates. They want to cut rates. I think that's not an issue on the Fed side, but it's really about making sure that they actually are the right moment or the time that they can. Because if they don't, there's a worry in the fact that they, really make the wrong decision at the wrong time, and let then things just heat up again and it becomes too inflated, right? So slow progress is I think why they're focused on the inflation side of the mandate.
Right. Well, I think today's report was certainly a step
Yeah.
in the right direction. Thanks, Ben, for coming on the show.
Thank you, Elena. Great to be on. Thank you.
That was Ben Emons, founder and CIO of FedWatch Advisors. Thank you for tuning in today.